It's been a really busy week of central bank meetings this week. The headline, of course, being the Federal Reserve on Wednesday, but we also heard from the Bank of England and many others as well on Thursday. And while we are seeing many of them now at or near the end of their tightening cycles, the way with which they choose to end it is interesting because we are seeing some differences. For example, last week we had a dovish rate hike from the ECB. So while they raised interest rates one more time, they did suggest that it's their view that they've now done enough to get inflation back to 2%. And unless the data doesn't go as planned, then they will not be effectively hiking anymore. From the Fed's perspective, they decided to pause their tightening cycle this week, but they did suggest that another rate hike is probably still on the table, even though many people do doubt that, and that they will need to remain higher for longer. The Bank of England seemed to sit somewhere in between. They decided not to raise interest rates against market expectations, but their language was much more dovish. Rather than commit to higher for longer, they said they need to remain sufficiently high for sufficiently long. Now, this may just be a case of using different terminology, but ultimately meaning the same thing, or allowing for more flexibility. But I think that flexibility is really important. And I think the message they're sending is very important too, because they clearly don't necessarily believe that interest rates will need to remain higher for longer. And they don't also necessarily believe that they need to raise interest rates again. What is interesting, and the hawkish point that came from the meeting, was the vote itself. The Bank of England, the Monetary Policy Committee, voted 5 in favour of holding and 4 in favour of hiking. Very much on a knife edge. So it's clear to me, and I'm sure many others, which is why we see interest rate expectations still favouring the likeliness of another rate hike, is that it won't take much to tip the balance back in favour of those wanting to raise interest rates. And it could literally be Governor Andrew Bailey who tips the balance one way or another because he voted for the pause at this event. So I think that makes all of this really interesting at this point. And that also puts an enormous amount more emphasis on the economic data going forward as well, because really central banks could still move one way or another. This last month, the economic data has been more favourable, especially as far as the Bank of England is concerned. Anything slightly less favourable could tip the balance the other way. Now, as you can see here, we've got the pound-dollar pair. And on this chart, there's a few things that really stand out for me. I will start with that moving average pair. So this is the 200 233-day simple moving average band. Now, I often get asked why I use moving averages as a band like this. Firstly, I pick my moving averages based on the 200, which is the most widely followed moving average, simple moving average. The others are fib numbers. Now, this isn't particularly common, but I do find it interesting how the price does respond around moving averages that are related to fib numbers. And Fibonacci is used so much in trading that I thought it could be an interesting one to follow for moving averages as well. So the two purple are 55 and 89, and the other red, besides the 200, is the 233. A lot of people use 240 as well. It is worth noting. But what is interesting is when we came back into this moving average band, that is where price consolidated ahead of the central bank meetings this week, and the break below seems to have confirmed that move to the downside, and we have continued to trend lower since. We also traded within this moving average band back here in August period, and we moved briefly back into it here again going into September. We traded in the moving average band 55 and 89 as well during this period here. Too often I think we can get caught up with how markets are trading around a very specific level. And that can be difficult because I just don't think markets are overly responsive to very specific levels, but how they trade in areas, I think, can sometimes be a lot more interesting. And I think you can often see on my charts, I apply the same thing to support and resistance as well. So the break of those moving average bands, the 200, 233-day simple moving average band, looks like a very bearish move to me. And on the basis of a dovish Bank of England, which is typically negative for the pound, and a hawkish US Fed, which is typically bullish for the dollar, that all makes a lot of sense. Another thing I wanted to highlight on the chart here is a head and shoulders, which we have talked about previously. And you can see this head and shoulders, the left shoulder is here around June time, the neckline then coming in here around late June, the head up here in July. And this is where it gets a little bit murky, but initially the neckline came in around these lows that we were making here. You could make a case or an argument that actually the neckline comes into play here. The shoulder, again, roughly around this level. Nothing's ever perfect in this situation, but I think you've got a rough head and shoulders here. And that was the first inclination, really, that we were seeing a bit more of a significant move to the downside, because we saw the break of the neckline, which comes in here around 125.50. Quite a large head and shoulders pattern as well, which I think is also quite interesting. And what I like about head and shoulders patterns is, firstly, I have to stress this, there is no definitive thing in technical analysis with trading. They tend to give you ideas or the signals of what may or may not be happening, the strength of trends, the strength of breakouts, things like that. So we always have to take that in mind, especially when we're dealing with something like a head and shoulders pattern or a double top pattern. And the reason why that's important is because what people like about double top patterns and head and shoulder patterns is they give you possible price projections. And what I mean by that is they can, if you look at the textbooks, what they say is if we see a breakout, for example, from a head and shoulders pattern, you can roughly take the size of the shoulder, which in this case would be around here, back to the neckline, which in this case is around 180 pips. And you can then, that gives you a possible price projection lower following the breakout of that neckline, which would bring you back to around this kind of 120 to 60 mark. So this gives you the possible price projection from a conservative scale. And you can see that obviously that has already been more than achieved. Then you could use the same logic from the head to the neckline, which is a much larger number, around 550, and then you can give a possible price projection lower, again, possible, over a longer period of time. Now, that gives you a projection of around 120, and what's really interesting about that is that A, it hasn't been achieved yet, and it may not be achieved. Again, I have to stress that. But B, that then aligns with a big psychological number as well. It also roughly aligns with the 38.2% Fibonacci retracement level 2, which again, I think is also quite interesting as well. It may take some time to get to there. It may not even get there, but it may take some time. It may take some data to back it up. But the fact that we've seen a break of the neckline of the head and shoulders, and then followed by a break of the 200, 233-day simple moving average bands, two very bearish developments there, does suggest that we are gaining some form of momentum. The other thing that suggests we're gaining some form of momentum is the one other technical indicator that I often talk about, and that's momentum. And you can see this in the form of divergences. Now, I'll use arrows here on the screen because we are using live charts now, so it makes this a little bit easier. But you can see that we are seeing still slight downshifts in the stochastic, so lower lows. So the momentum is still very much, we're not seeing any form of divergence. Divergence is when we see price making, for example, lower lows, but we're seeing the momentum indicator making higher lows. That suggests the trend is weakening. But you can see it too on the MACD moving averages, very clear lower lows here, and even on the MACD histogram as well, you can see that we're also making gradual lower lows, not strong lower lows, but gradual lower lows. So that's three confirmation indicators backing the breakout that we've seen in the price chart as well. So that suggests to me that there is potential for more downside in this currency pair. Again, no guarantees when it comes to trading, no guarantees when it comes to the charts, and it can take something like a data release or a piece of news to flip this on its head. But if I'm looking at some of these technical indicators, then it continues to look quite bearish, especially following such a bearish breakout of the pound dollar below the 200, 233-day simple moving average. So clearly, while the balance has tipped in favor of a more of a bearish pound because of the dovish outlook for the Bank of England and the dovish pause that we saw on Thursday, and the hawkish elements of the Fed's announcement, even though they also paused interest rates. There's still a lot up in the air. The economic data is going to remain extremely key, and we could continue to see financial markets being extremely sensitive to small changes in the data that could tip the balance one way or another in 6 weeks' time when these central banks next meet.